Good morning, everyone. Welcome to MPC Markets Morning Call, 4th of August, 2025. Friday, stocks slumped on soft US employment data. Stocks fell sharply after the weaker than expected jobs data triggered fears about an economic slowdown. Amazon didn't really help either. Obviously, did beat on top and bottom lines, but market was very disappointed in the result, ended up down around about the 8.5% mark. A fair bit of that was already priced in. And we did see a fair bit of weakness in that NASDAQ and S&P 500 in the Asian session on Friday. As you can see here, the Hang Seng was already sort of down 1, China A50 down 0.5, Euro stocks, which did see the US payrolls number and was open while open for their day session while that was going on, down nearly 3%, down 3% for the week. Dow finished down 1.2. 1.6 down for the S&P 500 and just a notch shy of down 2% for the NASDAQ. The Russell was down 2, down 4% for the week, the worst performing index there in the US. We also led with down nearly 1% on Friday. As I said, due to that Amazon weakness, which is already down about 7.5% in the aftermarket on Friday. We sort of already had a fair bit of that weakness in there as it was. So we sort of preempted that move just a little bit on Friday. So as far as the payrolls numbers go, the Bureau of Labour and Statistics reported only 73,000 new jobs were added in July, which was far below the forecast of around about 125,000. However, it was the previous revisions that was the big issue, and we'll get onto that a little bit later. But amid this, obviously, this economic backdrop and these constant revisions in the payrolls numbers, President Trump actually fired the Commissioner of Labour Statistics, Erica McIntyre, now and accused her without evidence of manipulating job numbers. So. But we'll just run through the heat map here first. First things first, NVIDIA and Microsoft drifting off a little bit. Meta giving back 3% of that massive gain that they had earlier on in the week. Apple was down, Amazon down 8.27. We saw the financial sector get hit as well. So financial sector, a little bit of a bellwether in terms of, if the economy and the stock market's going well, the financials are usually going well because they're the engine room of the economy, and they started to give back a fair bit of the strength they've been given over the course of the last probably 3 months or so. You can see a little bit of a move into the more defensive sectors here: health technology, Eli Lilly, AbbVie, Johnson & Johnson. This little section here, and a little bit green, and in the retail trade, the Walmarts, Costco's, and Home Depots of the world, which are sort of cash flow kings, started to gain a little bit of a bid tone. They've been a little bit unloved, that sector, these two particular defensive sectors, with the market being in that sort of greed or extreme greed, and that's where people tend to obviously get out of that defensive and head towards more, there's more money in the growth names, which is on the left-hand side of the screen there. So, and we did have Exxon and Chevron as well report earnings on Friday, down 1.5 overall, nothing major from either of those guys. You probably would have expected them to be a little bit better bid given oil prices have been higher for the last quarter. However, it didn't pan out that way. So yeah, they're a fairly red heat map there, and a definite switch into those more defensive sectors. So let's get on to covering a little bit of payrolls now. So as you can see here, the 2-month revisions are the orange numbers, and the 1-month revisions are seasonally adjusted as well. Is more the maroon numbers there. Obviously, when we're coming out of, you can see here, we're coming out of COVID, those revisions were the other way. And look, these numbers are released on the first Friday of the month, looking backwards at the previous month. So there's obviously needed full revisions. However, the consistency of the downward revisions here since the start of the year, and I've touched on it a couple of times. I thought that the numbers were a little bit jinky and a little bit weird. They kept on revising. We kept on hitting that 120 to 150 mark. Now, net of immigration, the US economy is going to be putting on at least 100 to 120,000 jobs a month to maintain employment growth. So we kept on hitting that number every single month, and everything was okay, and the markets rallied out of it, and essentially what's ended up happening is, as you can see here, we then get a down 50 or a down 40, and then 2 months, and then the 2 month revision is even worse. So it's a pretty significant downside move. 258,000 jobs to the downside here. Are pretty much wiped off. So we're effectively in negative payrolls. So it's the largest downward revision since March 2021, and that was COVID, or that sort of coming out of COVID, and that's obviously not a good thing, and obviously pushing out these higher headline numbers has made the Fed fairly cautious in cutting rates, which is what President Trump's really got a problem with. And he wants there to be a show of weakness, to encourage the Fed to bring down rates. And obviously he's not getting that. So he's just turned around immediately. And because he can't fire Powell, being the guy that he is, he had to fire someone. And he's sort of tried to make an example, I suppose, of that Commissioner of Labor Statistics, and really did back up that with an official statement over the weekend as well. So, I think so this is what he's done since Friday. He fired the Bureau of Labor and Statistics chief. There was an official reaction to the weak jobs report yesterday, Sunday night. He's moved 2 nuclear submarines towards Russia, which is a very, I think is more one of those typical Trump magician moves where he's saying, look over here, and trying to distract the market from the fact that there's still no trade deals being done. He's re-announced the US-UK trade deal, and which, look, that was one of the first ones done. As I've said on a number of occasions, it really was, the UK is desperate to do a trade deal with anyone after Brexit, which was, in hindsight, a massive mistake. But also proof that nationalism can make you do silly things for your economy, which is history potentially repeating itself a little bit here with Trump at the moment. So, and then he's gone and attacked, an ex-official from the Department of Justice and stripped their security clearance, etc. So, look, a few little distractions there from the fact that we through another weekend, and if he's re-announcing US-UK trade deals, then that's not, there's no progress on other deals, which is obviously a bit of a problem. So, yeah. Now, and one thing I did skip over was some corporate earnings from some smaller names. Coinbase Global, which is one of the bigger crypto exchanges, they were on fire on Friday night. Over the course of the last few weeks, they ended up dropping back about 16% after they had a small drop in second quarter adjusted profit. Everyone just sort of expects with crypto up that that basically Coinbase would do very well. However, that could be now with the rise of the ETFs, and you can do a bunch of different crypto ETFs now. You can do Solana, you can do Bitcoin, you can do Ethereum. There's Ripple coming, which is sort of the top 4. Just those flows can be from more institutional sources, which we're seeing more and more, which do tend to flow into the ETF, which is the the New York Stock Exchange or NASDAQ listed exchange sort of flows. So they're not necessarily going into Coinbase, where the crypto bros kind of tend to live. So The ASX will probably have a fairly muted reaction to this US move. A lot of it, as you probably saw with that heat map at the start, was very much in the tech sector. So don't expect the tech sector to be too bad overall. And in terms of earnings this week, we've got Palantir tonight. Berkshire Hathaway would have been out over the weekend, sitting on a massive cash pile. The featured ones will be AMD on Tuesday. Pfizer, I don't expect too much out of, considering what's happened with Novo Nordisk. United Health as well got belted yet again. And, you know, what used to be the largest healthcare company in the world is probably going to be a buy at some stage, because it's probably too big to fail, but it's a massive case of not yet at the moment. Caterpillar's one that people do regard as a bit of an economic bellwether, heavy machinery for the industrial sector. Saudi Aramco, obviously not US listed. And Mitsubishi today, which will be out of Japan. So Mitsubishi is actually it's a far bigger company. It's sort of a little bit like Toyota, which is on Thursday. They also do heavy machinery as well, but they also are involved in defence and a little bit of aerospace. There's a few Australian companies that will be reporting this week: REA Group, Pinnacle, and QBE. And that really sort of starts, you know, a little bit of a drip feed of Aussie companies, because we are coming into earnings season for the Australian market. Really won't hit its straps until around about the week of the 14th, 15th. And so Eli Lilly on Thursday. We've got a bunch of old school companies, Disney, McDonald's. On Wednesday, Uber and Shopify, DoorDash, Airbnb. So in terms of economic numbers, not a huge amount this week. A couple of manufacturing numbers: ISM, services, manufacturing. Bank of England meeting on Thursday. The Bank of England tends to be a little bit more dour. They don't tend to spin the upside. Very British, very stiff upper lip, but they're you don't tend to get all sunshine, lollipops, and rainbows out of the Bank of England generally. And there's a fair bit of strange stuff going on in the UK at the moment. A bit of a political disaster as it stands. So now I'm going to finish with commodities today. We had a little bit of weakness in the US dollar just due to that payrolls number, because that does probably bring rate cuts a little bit forward. So US dollar was down, as you can see here. So the dollar index was down about 0.92. So gold was up a little. We saw silver up a little as well. Copper had a small rebound. Platinum up 1.6, and crude, iron ore, coal up small. Nothing major, no major catalyst there. So I wouldn't expect the Australian market to be. Obviously, the banks will probably get a little bit hit. Material sector should be relatively stable based on those moves, particularly with the US dollar. And our tech sector probably a little bit weaker. Bitcoin was down about 3.5% there as well, which is not really much of a move for them overall. But I don't expect us to be down anywhere near the 2% mark that the NASDAQ was. Probably expect us to be down somewhere between, the 0.5% to maybe 1% mark. It just sort of depends on how negative our market wants to get overall. So not quite as much out of Trump this weekend as I expected. They are obviously struggling to get trade deals done, and silence is usually a very dangerous thing with President Trump. So with the lack of any major announcements over the weekend, I would definitely expect there to be some sort of out there announcement in the first 2 days of this week overall, and probably on the positive side, I would imagine. I don't really expect this week to be too negative, but I think that when those payrolls numbers start to turn negative, it tends to snowball very quickly. And that is a leading, and it tends to affect all the other economic numbers. If people are cutting staff, if people are worried about their jobs, that is by far and away the worst thing that can happen to an economy, because it affects credit, it affects, it affects people's ability to plan or buy. It is the thing that knocks confidence the most. So next payrolls number, which will be obviously in about 4 weeks, will be one of the most critical numbers I would expect for the year, and will probably decide whether this market revisits April lows or whether it manages to just sort of hang in there and go sideways. So generally with these moves, in these seasonal moves, particularly, and when we have a bear market, there is usually, which we did trigger in April, it does tend to revisit the lows. It doesn't necessarily go through them. And a good example back in 2022 was it got within about 1% of that low again. But people have gotten really overconfident here at the highs. It's a good opportunity to take things off, but it will tend to grind lower for the first period and then have a bit of a capitulation where people will start calling by the dip. And then that will be where, that'll be possibly the wrong move to do, and then it will snowball from there. That pattern has happened time and time again in my experience over time. So if this is going to be a negative period, this is just the beginning of it, and you just want to be taking some risk off the table here at the moment, sitting on your hands, being a little bit patient, building that cash pile up, and making sure you get your shopping lists all sorted out, and for the things you want to buy when and if the market falls. So, but if you're well planned, a downward move is actually a big opportunity, as we saw for MPC clients back in April. So just be mindful that you can actually kind of make, if you're very well planned, you can make more money in these dips if you've got everything sorted leading in and you've got a decent little cash pile there. So don't see it as a negative, just see it as something you need to plan for, and that's something that can be a massive positive, because our ability to buy the dip with a high cash pile in April has really set up our year here at NPC, and getting another bite of the cherry could make it a very good year, and what's otherwise been pretty volatile and pretty all over the shop. But have a great day. As I said, review your portfolios, take off those things that you're not sure about or that are probably played out, and be patient. Sometimes being patient is the hardest thing to do, but it's the best thing to do. Have a great day, and we'll speak again tomorrow. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.